So what should we talk about next? Should it be what a bank really is and the creation of money? Maybe that, or
I
there's
think
so many
so.
places we could go with this.
Yes, that's true. That's true. But I think that's a fundamental one. That's a very important one. Where does money come from? And it turns out that most people's understanding of where money comes from and who controls money is not correct. Most people would think that the money comes from the government because that seems to make sense. And the government may delegate some of that to the central bank, but ultimately, it's a public function. It should be for the common good for everyone. There should be fairness. And somehow the government just has to put the money into circulation. Well, the reality is, no government in the whole world is creating any money. The last major economy where the government said, actually, we're going to create money, and they put several $billion in circulation, was the US government under John F. Kennedy in the year 1963. And it was the last year of his life when he challenged the Federal Reserve. And then, since then, no other government has dared to do that. And so if the governments don't create money, um, who does it? Now, what JFK did in 1963 is he issued United States notes. They look exactly like the Federal Reserve notes, but same design, everything, except they weren't headed Federal Reserve notes, they were headed United States notes. And they didn't have the Fed seal, so it was a challenge to the Fed. But that's basically not happening anymore. It was an attempt. At the moment, well, or since then, what's been happening is that we have the central banks. But even the central banks only create a small amount of the money supply, basically the paper money. Most people don't realize that we have been using digital money, digital currency for many decades. And that's part of the current, in this debate and discourse, obfuscation. They're saying, oh, let's introduce central bank digital currency because it's a digital age. We need a digital response from central banks. Well, hang on. We've been using digital currency for a long time. Central bank money is only around 3% of the money supply, the paper money, the cash. 97% is digital money created by banks. And we've been using this for decades. So we actually have been using digital currency for a long time, and it works very well, and there's no problem with it. But now central banks will come to that. They're saying, hey, we need central bank digital currency. Well, why? But they want more power. I mean, that's quite obvious. The central banks want more power. But before we come to that, let's just understand the status quo, what's currently happening, what has been happening for most of the last century, is that banks create money. Now, how do banks create money? Essentially, a banking license is a license to create money and put it into circulation. And that's also where what you mentioned at the beginning, this obfuscation comes in. Economics doesn't tell you that. Did you know that when you study economics, particularly when you study it on a more advanced level, and maybe do a master's in economics or a doctorate, there's no banks. All the economic models, economic theories, they leave out banks. There's no banking in it. And of course, we know with hindsight, well, actually, that's a crucial function. These are the creators of the money supply. And if you leave those out, people don't really understand how it works by coincidence. Convenient, isn't it? So how do banks put money into circulation? How do banks create money? When a bank gives out a loan, a bank loan, the money for the bank loan doesn't exist yet until you get the money paid to your account. That is the creation of new money. So effectively, banks don't lend money, they create money. And they create it when they do what we call a bank loan. So the money for a bank loan, which is the technical term is bank credit, credit creation, that is new money creation that newly adds to the money supply. So the more banks do what we call lending, normally, the more money is being created and added to the money supply. Now, of course, even though banks do this and they create the majority of the money supply through lending. Central banks, of course, are very much aware of that. Now, I produced the first empirical test to prove this because that was controversial. And a few years ago, people were saying, "Oh, that's a conspiracy theory." Was Professor Werner saying that banks create money? What a conspiracy theory! So I thought, well, and for 100 years, there's been this debate about where does money come from and how do banks actually work? Because today, if you look at the latest finance journals and finance textbooks, they all say, oh, banks are just financial intermediaries. They gather deposits, and the money they lend out is the deposit money they're lending out, which is not true. But you see, that's how they hide the reality of money creation. So I did an empirical test. I mean, what's the scientific thing to do? Can you believe it? For 100 years, economists have been arguing, it's the financial intermediation theory of banking that's correct. And a few were saying, no, it's the credit creation theory that's correct. Others were saying it's the fractional reserve theory is correct. That's a third theory, which is in between, which says that each individual bank is just an intermediary, but somehow collectively there's money creation in the system. That one was popular until the 1960s. And then currently, since then we have the current financial intermediation theory dominating, which says, no, banks don't create money. We've got three theories of banking. How do we find out which one is true? Do a scientific test. And so I did that. You need the corporation of a bank. I found one that agreed and let me look inside under the bonnet, so to speak, how the money creation was actually taking place. And I could empirically establish, this is in two peer-reviewed, published in peer-reviewed journals, published articles, that it is the credit creation theory, the oldest, which was known until 100 years ago, that banks create money out of nothing when they lend.